one of the best researchers now and is working with Websim platform. It's a privilege for us to learn today about Jens' expertise in alpha research. We are glad to present these virtual bootcamp sessions for you. Thank you for joining us today again during this weekend. We try to accommodate the timing for as much joining from different time zones. Consultants here who joined VRC 1 or ago, welcome to you and thanks for joining. We are also happy to meet those of you who became consultants recently. Special welcome to you. And again, special welcome for those who tried our platform recently. So the topic that we will cover today is basic time series operators and finding ideas using price volume data. And before we continue, let's have video and sound check, and I need your kind help here. So if you can hear me well and if you can see our screen with the lecture 4 slide, please raise your hand with the round button with a hand icon on GoToWebinar panel. So I see many hands. Thank you very much. We always try to make these sessions as interactive as possible. So please ask your questions at any time by typing them at the question tab. We will answer them either during the webinar or at the end of the session. My colleagues and me also, so we will be answering your questions behind the scenes. Some questions that would be interesting for the majority of audience will be answered orally. Now let me invite Jens to make his presentation. Jens, over to you.
Thanks a lot, Irina. And welcome everybody to lecture 4 of this bootcamp where I talk about the basic time series operators and a little bit on finding ideas using price volume data. I will kind of start with a question that was just asked, because to go off the regular schedule of presentation and the questions, because the question was, somebody's new to consulting and doesn't know a lot about finance and comes from a programming background. So those presentations are for you. So we don't expect you to have any prior knowledge in finance. So if you have a programming background and you have interest in finance, that's enough to get started. So everybody who joins the first lecture today, yeah, feel free to join the discussion. I hope you can learn something. If not, we'll talk about it during the presentation. But there are a lot of resources to get information on the Websim page. So, well, I hope you can learn something today and. Yeah, and ask nice questions, so we have a good discussion after. So the flow of today's presentation is the following. So we start with some basic time series operators, and then we discuss about various price volume ideas. So let's start look at some basic time series operators we have. So the first three are TS sum, TS delta, and TS delay. So TS sum gives you basically the sum of the data over the past n days. So it's well, something similar. If you think about it, if you sum the last 10 days of the value and divided by 10, that would be something like the mean. So TS sum can be sometimes interesting versus the mean. For example, if you have none in the data, then TS sum treats it a little bit different, or gives you different results than just the mean times 10 or something like this. All right, TS delta just gives you the change of the value today versus n days ago. Okay, and TS delay basically just returns you the value n days ago. So instead of TS delta of x, you could also write something like x minus TS delay of x. All right, and let me switch immediately to the website for a second, to the help section. So all of these operators, just in case you want to read along or read more about while you're listening to some of the presentation, you can find in the help section, so on the top right of the website,
So
fast
Jens,
expression operators.
sorry
Yes.
for interrupting you, please. So I have some messages that we have audio issues. So could you please check if everybody can hear you well?
All right. Thanks. So wait, let me quickly lower all your hands, and everybody who, let's say everybody who can hear me, please raise your hand now.
Great, thank you very much. I see that for many participants it is okay with the sound. Thank you, and sorry for interrupting.
No problem. So I maybe we can send a chat message to everybody to let them know that they need to check their own audio, so they know
Sure.
they're not unheard. Okay, thanks. Okay, so in the help sections, there's this section on time series operators. So if you want to learn more about or learn about more time series operators and a little bit more about the ones we talked about, you can click here and look for that. And we also have this description section where you have a more detailed description on some of the operators. Okay, let's go back to the presentation and to the next slide with a few more. One second. Examples. There we are. So the first operator here is the TS rank operator that basically ranks today's value with respect to the past n values. And gives you an output ranging between 0 and 1. So what does it mean? So basically you look at let's say the last TS rank of 5. So you look at the values of the last 5 days of the input data X, and you just rank those 5 values for each instrument. So if you have the highest value of the last 5 days, the rank will be 1. If you have the lowest value, the rank will be 0. If you're somewhere in between, it will be somewhere in between, depending on the rank. So if you're right in the middle, so you have in the last 5 days, including today, you had 2 values that were higher, 2 that were lower. You'll get an output of 0.5 for this TS rank operator. This is a very robust way to compare today's value to the history. So you can use, like in my example, the last week, but you can also use a year, like 250 days, 2 years, or half a year, or you can use any kind of n there in the past n days, and you get an idea on where your current value is relative to its own past. The second one is the second group is TS min and TS max. This captures a minimum and a maximum value in the past n days. So this can be interesting to understand. For example, last year's high of the price, TS max of close of 250 days, and then you can use this to relate today's value to the maximum or the high of the last year, or the low of the last year if you use TS min. Could also be interesting to look at the difference of those two, to see to see the range of the value of the data. So TS max minus TS min gives you an idea on typical values, or the typical range for the data for this specific instrument. Somewhat related is the next group, TS standard deviation. So this gives you an idea on how diverse the data is, or the time series is for one instrument. And another interesting operator, if you we'll have this in one of the examples, is TS core. So this is a correlation of 2 values in the time series. So let's say in the example we see later, we'll correlate the price and the trading volume. So you can look at the time series for the same stock of the price and the volume, and see how they if they're in some way correlated. This is especially interesting if you find alphas using this, because you create depending on the two input data fields you're using, you're creating some, or you can create some very unique data that usually creates very unique alphas. So if you can somehow process your data in a nice way, relatively early, you can get very unique data, and you will have low correlated alphas. So that's a nice thing to think of, how you can use those operators to create new sets of data. Okay, let's take a look at a few examples how you can use those operators. So the first example is basically you look at the correlation of the high price and the rank of the volume over the last 5 days. So this is somewhat like a smart reversion. Maybe, I don't know how, if smart is the right word, but it's like a little more advanced reversion. So basically, if the volume is increasing and the price is increasing, you think there's a real strong reversion signal. Because both are going up, so there's a correlation. If the volume is increasing and the price goes down, they go in. You have a negative correlation. But because the price went down, you think there's really a signal there, and you want to basically do the opposite. That's why we have the -1 sign here. Well, why is this interesting? Because sometimes you might see that the price goes up, but there's no real volume on the market, no trading is happening, but the price goes up. So you would think this is like a weaker signal, where you don't really expect a price reversion versus looking at the extreme correlations. But you can think about now what happens if the volume goes down. Then we get some unwanted effects. So maybe we want to split this whole expression and make it a little more complicated, or look at those different cases and want to do a little smarter things than just TS correlation. So maybe you already get an idea how to improve this example. So second example, let's move a little bit faster through them. TS rank. So this is basically you compare the closing price in high plus low over the last 20 days on a time series basis. So so this is, well, a kind of a vanilla TS rank. So you put any data into TS rank, you can see how the recent trend of the data is. Does it go up or does it go down? And the last example is comparing the recent, or today's volume to the recent past. So comparing today's volume to the sum of the volume, or the total volume of the last 60 days would be something like volume over TS sum of volume 60. You can think about replacing this TS sum with TS mean if you want to, or anything else. Like you can normalize it, divide it by 60, but depending on how you're using it, you might be fine with using the sum or the mean. So it's always good to keep this TS sum and mean in mind, and decide what do you want to do better there. I see I should talk a little louder. Let's try to do this. All right. So let's look into fighting an idea using price volume data. So there are two basic price volume strategies: the momentum or trend following price volume data, or price reversion or reversal. So this is the reversion towards the mean of the price. So momentum, well, is basically trying to capture the trend of a stock price, which is likely to continue, and reversion, you try to do the opposite of the recent trend, because you think the price will go back to its average price. So let's take a look at some examples on an example on mean reversion. Sorry, I leave this slide up for a little bit. So the mean reversion example we're going to show, we're just going to look at the closing price. So we saw before. I looked at the correlation of the price and the volume. So this is like this example is a classic reversion. So you look at the closing price and the average closing price of the last 5 days or the last week, and if you today your price is above the average, so close will be larger than the average of the last 5 days. So whatever is here in parentheses will be positive. So the whole thing will be negative. So you most likely will short those stocks. So the ones where the price went up, you will short. And the other way around, if the closing price is below the average of the last 5 days, the parentheses will be negative with a minus included. The whole term expression will be positive. So you will more likely to long the stocks that recently went down, or that are below the mean of the last week. So let's move to Websim to run this simulation. I'm copying this. Can I? No. Okay. So minus close. So feel free to open your browser and go along with us and simulate this as well. So we take the close minus the sum of the last 5 days divided by 5. Now let's set the neutralization to sub-industry and the decay of 5 days. And I hit simulate. So in between, I see there's a question, does the business week interleave with weekends, meaning 5 days include Thursday, Friday, Monday, Tuesday, Wednesday? So all those TS operators, I hope I understand the question right. So all those TS operators, they are the days are in terms of business days or trading days. So
yeah.
if you do,
sorry,
yes.
please let me jump in for a second. Could you please increase the scale at your screen?
Oh, sure.
Increase the scale. Thank you.
So what was I saying? Okay. So the decay of 5 days, it was just an example to in order to reduce the turnover a little bit. I see this as a question now coming in. And yeah, so like I said before, the 5 in all those tiers, the number of days in all those tiers operators is in trading days. So 5 would be here 1 week. This is the number of, or usually 1 week. That would be the number of trading days per week. So now that we have the simulation results coming in here, so we see the P&L, it goes up, and now we take a look at the stats. We see a turnover of 46%, which is on the high side. The sharp of 1.4, the fitness of 1.14 looks promising. A sharp of 2 looks also promising, but we also see, which is maybe a general advice, if we look at the per year sharp or returns, we see that it worked nicely until 2016, and then in the recent past it kind of reverted to losing strategy. So if you look back to the chart, we can see something like this. So this looks really nice until somewhere around 2016, and then kind of gets flat or maybe even loses some money. So this happens a lot to some alphas. So this can have many reasons. So the market doesn't stay the same. So sometimes there are changes that just break an alpha, or sometimes it's just the that the general public or the market, the players on the market also know about this alpha, and as soon as they, or if enough people trade it, then the edge that you have with the alpha will be gone. So there are a lot of reasons why an alpha might stop work, but this one looks like one that maybe stopped working. Maybe it needs some tweaking to to improve it, or to like one up everybody who just uses this kind of simple expression. So maybe there are kind of some flaws that you can fix, and then you have an alpha that keeps going up. Now, for everybody who's already a consultant, we take a look at the data visualization. So this is a feature that you get to use once you become a consultant. So if you're currently a user, you will not be able to see this, but I will take a look at this anyway. So now you might be a little intrigued and try to become a consultant faster. So then you can also get those additional information to the alphas. So one thing we can see here is the alpha coverage. This is an instrument, so it's like of the top 3,000, we get a nice coverage of almost 100%, so 290 stocks we're trading here. Another thing I like to look at is a sharper capitalization. So here we see that the large cap stock, so the big stocks, make a lot of money, and the sharp is nice here. So those are the stocks that are easy or cheap to trade. So it's always good to see a good performance in the large cap stocks. While the small cap stocks we could improve, so maybe we'll find a way to improve this. So we saw this with the a little bit. I talked about this in the volume correlation of price and volume example. So maybe the low cap stocks sometimes show a signal of price reversion when it really isn't, because the volume is not big enough to really support the idea of price reversion. That's just an idea. Maybe you can find a way to capture this and improve the low cap performance. Okay, so let's go back to the presentation. And this is a performance here that we just looked at, and we'll continue with technical indicators. So technical indicators are mathematical calculations based on the price or volume of a security. So they are widely used by various people in the industry, and the idea is that we try to analyze historical data and define indicators that predict future price movements. So examples are RSI, that's a relative strength indicator. We're going to look at this a little bit in an example after. MACD, so this is basically it's a moving average convergent divergence indicator. So this is a difference in moving averages, and the most prominent that you read everywhere is the SMA, is a simple moving average. So this is just like the time series mean. And EMA, the exponential moving average. So you can calculate something like this in Websim using the exponential decay, for example. So let's take a look at the RSI. So there's the relative strength index. So this is a quote from Investopedia. The relative strength index, RSI, is a momentum indicator developed by noted technical analyst Wallace Wilder that compares the magnitude of recent gains and recent losses over a specified time period to measure speed and change of price movements of a security. It's primarily used to attempt to identify overbought and oversold conditions in the trading of an asset. So the two things that we see here in this sentence, we want to compare the recent gains and the recent losses, right? And in a way, we need to translate this. There's also a formula. If you go on the website, or just Google RSI. We want to translate this into a Websim expression. And so this is I think one way to do this. We calculate the recent gains. So we use tier sum with a conditional operator. So if the closing price goes up, I want to sum this delta in close over the past 14 days. If it didn't go up, then I just replace the delta close with 0. And the recent losses, I do the same, but well, if the closing price went down, I take minus delta close, right? Because it went down, so it will be negative, and I want the recent losses to be positive. And if the price goes up, it's 0. Also over the last 14 days. And then the RSI in this example would be well, 100 minus 100 over 1 plus recent gains over recent losses. So this will give you a value between 0 and 100. And our alpha is just simply minus RSI. So it's a kind of reversion around this RSI indicator. So let's take a look at this in the on Websim. I already typed this because it's kind of long and already simulated it before, so we don't have to wait too long. So the P&L looks has a familiar behavior that it worked nicely in the past, and it starts to work less nice in the recent history. So this is like a very how to say it, like a sad thing to see. You see that a lot of times with ideas that you're just too late in history to come up with it or to simulate it, and enough people to start using this alpha, or there are some changes in the market that make those good old indicators behave differently than they used to. So if you look at the sharp end of this simulation, we get a sharp of 1.5. It's a promising beginning, so maybe with a little bit of work and a few improvements, we can figure out how to improve this. The fitness is all right. It's below 1, so usually if you want to submit an alpha, you need to reach fitness of 1. So there's something to work with. So the turnover of 40% is probably a little bit on the high side. So maybe you can work on this. You can try to improve the returns, and well, most importantly, try to figure out how to fix it in the recent past. Again, a consultant feature. I like to look at the sharp by cap. So because a lot of times when you deal with those price volume alphas or alphas in general, sometimes you notice there's a difference depending on the size of the company. So the market is observing companies with a large cap. These are usually the big companies, the S&P 500 companies that get much more attention. So the reaction on all those technical indicators might be different for those versus the small companies. So if you look at by cap, well, it looks nice across all caps. So maybe even a little bit better in the bottom half of by cap. But yeah, something is very, very bad here on the not so big, but also not so small companies. So might be interesting to understand why this happens, or if you find a reason for it. Another thing that is nice to look at is sharp by sector. So that's another thing where companies might behave differently if they come from different sectors. And well, here we also see that most of the sectors give us a positive P&L. Some of them not so good P&L, but we don't need to have an alpha that works in every sector, but even though it's nice to have. So especially if you're working on fundamental alphas, which is looking a little bit ahead to the next sessions, it might be interesting to look at why a specific sector does not work. So sometimes it might not work because the fundamental values you look at are not interesting in this industry. Trying to think of well, there are examples that we probably will take a look at. So some companies might not have a big number of assets versus so utilities companies probably have a lot of plans and a lot of assets where technology companies might have the most value in that is more abstract in the brand or in intellectual properties. So well, let's go back to the presentation one more time and move through those results and look at how to find alphas from papers. So there's one paper that has a lot of alpha ideas in it and might give you some inspiration on making your own alphas. So it's called 101 Formularic Alphas. So you can find it on SSRN. So here's a link. I don't know if you're fast, you can just copy it, but you can probably just search for 101 formularic alphas and you'll find the paper as well. So one of the example alphas that comes from there is the one that we saw in the beginning, TS correlation of high and rank volume. And so there are much more examples, and they're very specific, very close to the Websim language. So it's very easy to go to this paper, pick any. Wait, I have it open here. So there's some introduction text, but in the appendix you see just one alpha expression after the other. Let me zoom in. I hope it works. So you see a lot of examples on alphas. They might work, they might not work, but I think the most important thing is that you can get inspiration on what you might want to try, and maybe you get an idea on on why something works if you try to understand it really, or why something doesn't work, and then you can improve it and might find a new alpha. So there's a whole list of 101 alphas. So this is a very easy way to start looking at a paper and get examples for alphas, because it actually has alphas in there. But like I said, in general, try more than just trying to copy them. Try to get inspiration from them. And I think this is when you then move to more sophisticated or more indirect papers. It will be much more getting inspiration from the paper than just copying a formula and you get an alpha. The same is true for the for the technical indicators. So maybe a technical indicator itself will not get you an alpha, but it might give you inspiration of what you want to look at or what you want to calculate. So maybe it gives you the idea of, instead of looking at the volume, which is the number of stocks traded, maybe you want to look at the dollar volume. So this is the amount of money traded. So you take volume times the price. I know common is like to do VWAP or close, whatever you want. So maybe you get the inspiration from a paper or from some other research that they were looking at this kind of data, or they were normalizing the data by the standard deviation or something like this. So there's even if you don't find a direct alpha in a paper, there's always there's most of the time there's something that gives you an idea what you want to try or how you want to get some more interesting alpha out of your initial ideas. And so to almost we're almost at the end. So to close it, one Websim exercise that you might want to do for yourself. Look for an technical indicator that you think is interesting, and try to create 3 alphas based on this indicator that pass the IS testing. So it's a tough one. You might need to try a few different technical indicators, but I think if you do this, you learn something about technical indicators, which is nice because it helps you to understand how some people on the market think and how they trade. And it helps you to try to understand or take a mathematical expression that you see in some paper or in a website explaining you the technical indicator and how you can translate it to a Websim expression. And then you maybe find also ways how to or different ways how to do this. So it's not always just one way how you can translate an idea from the math or from your brain into a Websim expression. So doing this in a few different ways is always interesting. And maybe you can even create a version of this technical indicator that is slightly different, but maybe works better in the simulations on Websim. So that's like one exercise that you might want to take. And to finish it, we always have the sources and references. So Investopedia gives you a lot of info on technical analysts and the concept of technical analysis. The paper of 101 formulaic alphas, and of course the Websim help. So I'm going back to the website one more time. So again, for everybody who joins the first time, there's a Finance 101 section with basics of finance, papers on research, which is a list of some recommended papers, and there's a suggested readings, which is a huge long list of papers that, depending on you can see the basic category of them, so you can just pick one and hopefully find something that is interesting. You can look at the title of or some keywords of the paper if you're into learning something specific. So yes, so that's it for today. Thanks a lot for your attention, and we move on to the questions now. I'll go back to the references while we talk about the questions. Thanks a lot.
Thank you, Jens, very much for all your expertise to be shared with us. So let me start, please, with some questions. And we have already several questions on the same subject. So could you please give us some more information about time series operators in general, and about maybe some examples or some more information about moving averages?
Sure, I'm trying to. So let's open the help page. That's my go-to page, just to have something to show. So the moving average, the simple moving average, is basically, or SMA is basically the average of the last of a specific input over the last 20 days, for example. That would be the 20-day simple moving average. So I'm taking so in Websim, let me quickly scroll to the TS operators. We have we don't call it moving average, it's just TS mean. Okay, so here you can the data input is X, and you have the last n days, and you just get the output is the average of the last D days here in this case. So that's the equivalent of the simple moving average. So every day a new value comes in, and the oldest value goes out of a window of 20 days. So that's a simple moving average. The exponential moving average is similar, and they're like slightly different ways of how to calculate it and how to define it. So let's just think of 20 values we have. So instead of just building the simple average of those 20 values, we can value the more recent data more. So in our average, we put higher weight on the recent values. So basically, you calculate a weighted average, and the weights of the values is is like an exponential decay. So we have here in Websim, we have the TS decay exponential window. So you can the input is the data, a window that you want to look at. This can be rather large if you want to, and the factor, which is how fast you want to decay the data. So the smaller the value, the slower you decay, or the longer or the more you spread your current value over the past days. So that was a bad explanation, I guess. So if the factor is 1 or is very close to 1, you're basically looking at even if the window is 250 days, you're looking only at the very recent days. And if you now decrease the value of this exponential factor to 0.1 or even lower, you take into account much more of the recent values. In terms of well, you can think of it as like an exponential smoothing kind of thing. So that means the lower the factor is, the more you smooth the data. Okay. A related operator is TS decay linear. So it does something similar. It's also weighted average of the past D days, but instead of doing an equal weight like the TS mean on exponential decay of the weights, the weights decrease linearly. So I don't know, without normalization, it would be you put the weight of, if you look at the linear decay over the last 5 days, you put 5 times the weight on today's value versus 5 days ago value, and in between it decreases linear, so it's linearly. So yesterday's value gets 4 times the weight of the value 5 days ago, and so on. Here it's interesting to look at the dense flag equal false. So that's the default value. So this means how it treats when a none comes into your time series. So dense equal false means, well, even if a none comes into my time series, so let's say the value is the time series, I'm looking at the last 3 days. The time series is 1, 1, none. If I do 10 dense equal false, the output of this will be we'll treat the none that came in on the last day as a 0, I guess. So you'll get still an output. If you do dense equal to true, then you will treat the none as really a none, and the output will be a none. So this is something to basically kill your signal and get out of position if you get a none into this linear decay. So that's an interesting thing to play with. The false is a default because it's I think the most used option here. And this linear decay, just as a side info, that's also the decay. Sorry, the decay that we use, that is used after your expression if you set the decay here in the settings. So a decay of 5 means over 5 days, a linear decay. I know. Do you have anything to add, Irina?
Well, Jens, thank you very much for such large explanation with so many information. So nothing to add from my side. And let us please move on to the next question. So at first, could you please go through last 3 slides? So we have a question like this. Last 3 slides. Could you please show them again? Thank you. Thank you very much. And we also have a question about these papers, how the listeners could find them. So now you can see at your screen the links to this paper, so feel free to search for them and to look at these papers. We also have one question about this first paper, and the question is, can we somehow find the settings for this alphas? So as far as I understand, we could just read this paper, and if this information is indicated in this paper, you could find them. In other case, I would recommend you try these alphas by yourself if you find a good one, and try different settings, different variations of them to find out which will work better for you. So Jens, also we have a question about this alpha with TS correlation operator. So could you please explain again the meaning of this operator, TS correlation, and this alpha idea?
That's a good question. So the correlation basically looks, the TS correlation operator looks at the time series of the high price in this case here, and the rank of volume, and looks at the last 5 data points of both of them, and then calculates a correlation between those 2 time series. So so that would be basically the idea is you plot those 5 points, high versus rank volume, and calculate the correlation of it. Correlation is similar to a regression of those points, so but not the same. So the idea is if 2 values are correlated, that means that they tend to be proportional to each other, I would say. So it tend to be that a high price or a high price usually comes with a high rank of volume, and a low high price comes with a low rank volume. Then those 2 quantities, high and rank volume, would be correlated. If the opposite is the case, so a high rank and volume comes with a low high price, and a low rank and volume comes with a high price, then those 2 quantities are uncorrelated. If 2 things, two time series are correlated, then the output will be positive, somewhere between 0 and 1. And if the output is negative, somewhere between 0 and -1, we call it anti-correlated. And if it's somewhere around 0, we call it uncorrelated. So, and the idea of the alpha is, I believe we're just looking at increasing volume. So if we have a week where the volume goes up, so the rank of volume is high of this specific stock, and or increasing, and with increasing volume the price also moves up, we get a high correlation between those 2 time series. And what does it mean? That there's a increase in the price, and it is carried by also an increasing volume or a high volume of this particular instrument. So there's real trading going on, and the price is going up. And if this happens, we like to believe that there will be a real price reversion. So we have the volume basically as a feedback of our increasing price, and the same if the volume goes up, but the price goes down, then there will be this will be anti-correlated. So it will be negative, and we believe that this is really an indicator for price reversion from negative returns to positive. different question. So you can think about how to interpret the other results, or what happens if there's no correlation between volume and price. There might be um, um, there might be a signal there too, but we wouldn't really catch it here. So we try to stay neutral with that. So I think in general, when you work with a correlation, a TS correlation, there's always, you have two quantities. So you can think about what happens if both of them go up together. That's like a high correlation. What if one goes up? When one goes up, the other one goes down. That would be a negative correlation. And you can think about the one goes up and the other one doesn't move. That would be uncorrelated, or the other way around. So there are few scenarios that you can think through and try to understand what happens. With the rank of volume, you can think about, this is just ideas how to improve it. So the high price, obviously you can replace it with any other price. Maybe you also want to look at moving averages of the price of a very short period. So the price reversion is typically on time scale, so it shouldn't be too big of an average. And the volume, maybe you want to normalize the volume in some way. So this is, maybe you learned this in previous lessons. So we like to look at normalized values a lot of times. So we don't want just a high volume, but we want the high volume relative to something. So for example, the relative to its own volume in the past. So we have this field ADV20, which is the average daily volume over the last 20 days. So that would be interesting to maybe compare the volume to this before ranking it. All right. So I hope this answered some of the questions.
Thank you very much, Jens. And I also wanted to address you, please, with the questions about the alpha with RSI indicator. So we have several questions. Could we please combine them together, and maybe you just provide us once again some details about this alpha and this indicator?
Sure. So I'm trying to find one of the questions to be more specific, but okay. So one of them, let's talk in general. Maybe this is the first thing to what I'm doing here. Might be for new users now. So so I'm setting a variable called recent gains to this expression, and then I end the line with a semicolon, and I do the same as recent losses. And then in the third line, I can define RSI using those two expressions as variables. So at the end, it would be the same if I just take those big expressions and plug them in here in the bottom. So there's no I don't know, like no magic with variables going on. So it's just a way to make the whole expression a little bit more readable, I guess. And then, well, the last line then says minus RSI. So this is the actual alpha that you would have in a normal, that is calculated and simulated. So replace the minus RSI with this expression, and then the recent gain and recent losses with those above. Then you'll have what the alpha that you simulate. So, and well, so there's one. I think in general there are two things we could talk about, and I like to talk about the alpha more than the RSI. So the you can read about the RSI index, but it should be like a signal for buying or selling stocks. And the way it works, like in our simulations in the market, is, I think, more interesting than the theoretical ideas that came when somebody came up with index, because it might be different than what we really see in simulations. So I think part of this is, so if you look at this expression of the RSI, we have 100 minus 100 over 1 plus recent gain over recent losses. So let's go with the first thought here. Let's say we don't make any money in the last 14 days. There are no recent gains. So the recent gains are 0 and the losses are something. So what does it mean? So recent gains over recent losses is 0, and the whole RSI is basically 100 minus 100. It means 0. So if there are no recent gains and all losses, then the RSI will be 0. That's the smallest value it would take. So and let's look at the other extreme. Let's say the recent losses are 0 or very small, and the recent gains are we only have gains in the recent past. So then 1 plus this fraction, like in the extreme case of recent losses being 0 or close to 0, this would be a very large number. 100 over this very large number will be a very small number. So our RSI will be close to 100. So if we have only recent losses, the RSI will be 100. If we only have recent gains, the RSI will be 0. So now the fact that minus RSI produces some results in our simulation tells me that this is another way, or a little more fancy way to express a price reversion going on. But there's a little bit more going on. But I think this is will be my first thought about this. So if there are recent gains and no recent losses, the RSI is the price went up in the last 14 days. The RSI will be 100 or close to 100. So minus RSI will be minus 100. So I'm going to end up shorting everything that won or had a lot of recent gains, and I'm going to long, because the RSI will be 0. I'm going to long everything that had only recent losses. Yeah, so I hope this answered some of the questions. So this is, I think, the strongest, or one of the ingredients here, is that there's some sort of price reversion in there, but there's a little bit more about the actual size of the changes in price.
So yes, thank you very much again. And now we are just out of time for this session, and we have to close this webinar, but we still can answer your questions in written form. So please stay with us. If you asked us some question, we will answer you soon. So thank you again, everyone, for joining us today. And Jens, maybe some closing remarks from your side.
Yeah, thanks everybody for joining and being so active with your questions. Yeah, it's always a pleasure to answer your questions, and hope to see you next week in the next sessions.
So thank you, everyone. I wish you success in your alpha research. Hope to see you at our next sessions. Bye.